Learning Objective 5 is a measure of quality of debt, and that will indicate the price paid. Let's start with a baseline. It's called the market rate, and it's what the U.S. Treasuries trade for. That's the lowest rate that is you'll find in the world, because the lowest risk, hopefully, of anybody in the world is the U.S. federal government and the U.S. Treasury. That's often called the risk-free rate, assuming there's zero risk in the U.S. Treasuries. Here we see the dark line, which is the risk-free rate. So it's the Treasuries for a 10-year bond. The blue are AAA rated bonds, and you see a gap, and that's called a premium or spread. People buying a corporate bond will need more than what the Treasury is. It would be silly to get from a corporate bond a lower rate of interest than the Treasury, because a corporate bond has risk. A Treasury rate has no risk. You're paying a little premium if you take the risk of the corporate bond. Now, if you go to BAA, which is right on the edge of institutional grade, you now have to expect more than the kind of the safer corporate bonds. You want more money, more interest rate, because you're taking on more risk. Always going to be this order, but you see that the spreads or the gaps vary over time based on economic conditions. Credit ratings are now related now to the company side. Credit ratings are where a credit rating agency measures the risk of default. Default is the bad thing, right? We put all this money out to buy a bond and they don't pay us. Either they don't pay us interest, they don't pay us the principal, or they otherwise break a promise in the bond agreement. So rating agencies do this for a living. They look at the issuers and rate how likely it is that that issuer will pay as they promise. The ratings, and the three rating agencies, we've seen this before, are Moody's, Standard & Poor's, and Fitch. And they have slightly different nomenclature, but they basically have the same idea of super high quality. These are maximum stability. We call them AAAs, down to right here at this dotted line, which are BAAs for Moody's, or BBB minus for S&P, or BBB minus for Fitch, right? Anything below that is below investment grade. Anything above it is considered institutional grade bonds or issuers. Now, when we get down to C's here, this is junk territory. So in that comic strip in the beginning, we were talking about junk bonds. They are the C or C level bonds. So who determines them? Well, these three rating agencies do the rating, but they base it on the understanding of the default risk, which has both business considerations and financial. It's looking at how well the company's doing, how safe they are in their industry, and also they look at how they're doing financially. Are they generating cash flow or not? Credit rating agencies then would look at the ratios. So we've been doing a lot of ratios, and I'm not going to do every one of these. I did one earlier in our module in class. You may or may not remember that day. But these are different ratios that look at the health of the company and may measure profitability, asset turnover, cash flows, things of that sort. And the simple thing to remember at a high level is as you go from higher grade bonds to lower, the rates go from better to worse. EBITDA, as divided by total assets, is a measure of profitability. The higher the profits, the higher your rating. The lower the profits, the lower your rating. Then we go all the way to the other side. Let's say debt to EBITDA. In this case, we don't want a lot of debt. We rather have less debt for every dollar of profits. And EBITDA is a form of profit or cash flow from profit. The higher it is, the higher your debt load is and the riskier you are. These ratios all kind of probe at a certain aspect of the financial position or performance of the company. And we can see that the ratings array from high to low risk matching with the high to low in that particular ratio. Not the numeric value, but the high or low performance in that ratio. So looking at Verizon, they went through this rating, and the blues represent the major items. So 27% plus 47, or close to 3/4 of the rating, is based on these two factors. The first is a measure of your industry position, and the bottom one is the big one, is money, right? It's financial strength. Other things like operating environment, financial policy, and overall performance, of course, are meaningful, but the two major ones are your industry competitiveness and your financial performance. And breaking out those 5 factors into the components, we have the last 12 months and then kind of a looking forward view from Moody's. And these numbers are AAA for the market position for Verizon, But where they fall down is right here. They fall down in their financial performance. When we look at the components and when we push them all together, we end up with BAA, which is, again, just above institutional grade. Above as in it is still institutional grade. Moody's rating, they have the summary. Here is that we rated them Baa1 because of their scale, where they have some strong positions. However, and just talks about their debt position, right? So it looks at some of the risk in one phrase, but it basically reflects the 5 components that we saw on the previous slide. Why do credit ratings matter? They matter because historically they've been remarkably accurate. The AAAs down to the BAAs have very low default rates, but once you get below BAA to the BA1s all the way down to the Cs, the default risk jumps. So I think they were somewhat vindicated in the ratings because when you look historically at the ratings they provided and the default experience, they've been pretty good. I said pretty good because all 3 of the agencies completely blew it with the mortgage crisis, right? So all this kind of good talk about rating agencies excludes the one blight in the recent history, which is what they do to precipitate the crash of the mortgage market, the bond market for mortgage-backed securities. Summarizing Module 7, liabilities, we have accrued liabilities, which are adjustments we make to recognize that we have incurred some expenses that have not yet shown up on the income statement or balance sheet. So we make it appear there, and therefore our financial statements are in conformity with GAAP. Next is short-term debt, right? It's money we owe in less than the next 12 months. It's debt, typically loans to a bank, that are due within a year. Then we have pricing of bonds, and this was the very complicated piece where we say that we have to understand the nature of the security, which is the bond. And the bond has 5 key factors. And if you know these key factors and the market interest rate, the effective rate that the market requires, then we will know the price of the bond. And we did it 2 different ways. We used the time value of money formula in one, and then we also used the Excel function called equals PV to establish the price of the bond. Fourth was the reporting of bonds, and this is tricky because when we first issue the bond payable equals the cash we received. But over time, as we approach the maturity date of the bond, those dollars have to move from whatever cash we received to equal the face amount of the bond. And that often requires the amortization of either a premium or a discount. It's very rare that a bond is issued exactly at par. So there's usually a small or large premium or discount involved. And LO5, Learning Objective 5, is the quality of debt, starting with the highest quality, which is the U.S. Treasury, and moving to corporate bonds. And within corporate bonds, we have the 3 rating agencies using various ratios and other analysis of industry to give investors a sense of what is the default risk of that particular issuer. And we see it start from AAA for highest grade institutional or BAA being the kind of the threshold of institutional grade, and then BA and lower being below grade, going down to C, which is junk. So this has been an important part of how the money flows in the US and internationally. What I'm talking about is the rating of the 3 rating agencies, despite their glaring failure and breach of trust, frankly, during the mortgage crisis. All right, so I'll see you in class, and my suspicion is we'll have to go through bonds a little more carefully, but it's okay. I always spend time in the classroom to explain how bonds work, both conceptually, but more importantly, how the math works to do bond pricing and to calculate the effective interest rates. All right, so see you soon. Bye-bye.